So what does it take to qualify as a real estate professional in the eyes of the IRS? Hey everyone, I wanted to take a minute to talk about real estate professional status, reps, and what it's all about. And when we talk about reps, the only thing getting swole here is your wallet, if you understand it and you're able to leverage this properly. So what is real estate professional status? It's an IRS designation. So the IRS designates every real estate investor into one of three categories. You're either passive, active, or a real estate professional. Now, these statuses have nothing to do with any licenses that you've obtained, any education that you may have. Like, that's all great for what you need to do in real estate, but it does not matter for these statuses. There's only really two things that matter: how much you work in real estate, and specifically qualified real estate activities, and how much you work in anything else. And once you understand that, you'll start to understand how you can really meet this and what it means if you do meet it. So let's break these categories down. What's a passive investor to the IRS? Again, passive, active real estate professional. A passive investor is someone who invests in real estate without doing any work. So if there's a real estate investment and I want to give some funds or money to it, and then I get a payout from it at some point, I'm a passive investor. If I'm a passive investor, I can take any income that I have to pay my tax on any passive income that I have. If I have passive losses on paper, I can only use those passive losses to offset my passive income. I can't use those passive losses to offset W-2 income or any other income. I'm passive. If I have passive losses in excess of my passive income, those get locked up and they carry forward. I can use them in a future year when I have passive income, but they will never be able to be used to offset active income. So let's move to active status. What's active mean? Well, I have a feeling that most of the investors in our community are active investors. So if you do any active work in real estate, you are active. If you're hammering nails in, if you're finding properties, if you're doing any active work in it, then you've moved to an active investor. What are the rules for someone that's an active investor? Well, the IRS says each year, any losses you have from real estate, they're passive, and you can take those to offset passive income. So if you have other income from real estate holdings, if you have business that you own passively or some other K1s that maybe you get passive income from, PIGs, passive income generators, then you can offset those. However, if you have passive losses in excess of passive income, you can now take up to $25,000 of those passive losses and move them to the other side of the equation to offset your active income. So if you have income from W-2, retirement distributions, a business that you run, your flips, your wholesaling, any of that, you can use up to $25,000 of these losses real estate to offset that active income. However, the problem in being an active investor comes when you become a high earner. And really, as a high earner in this case, it's not even that high as far as what a lot of you might be expecting or assuming as a high earner. So again, they give you this $25,000 allowance that you can take from the passive side to the active side to offset it. However, once your adjusted taxable income goes above $100,000, whether that's individual or married filing joint, then they start to reduce that allowance. So for every $2 above $100,000 of adjusted taxable income that you earn, they take away $1 of the allowance. Meaning if you earn $150,000 or more in adjusted taxable income, then you cannot use any of the $25,000 allowance. So again, you're kind of back to square one. You're back to the same as a passive investor. So for a lot of real estate investors, especially those that have high earning W-2s or spouses with high earning businesses or W-2s, they're back to the same spot. They have passive losses, they can use them to offset their other passive income, and then they get locked, suspended, and carried forward into a future year, or until they sell it just outright without a 1031 exchange. So again, this isn't the best spot. It's better than a passive investor for a lot of people, but it's not the best spot to be. So then we go down to the third status, reps, real estate professionals. So what does it take to qualify as a real estate professional in the eyes of the IRS? Well, you have to do two things. One, you have to work at least 750 hours in qualified real estate activities. And two, real estate has to be what you do with over half of your serviceable time. That essentially means you cannot have another job that's not related to real estate or run another business that's not related to real estate. If you are working a W-2 job and you don't own at least 5% of that company, it's going to get tough to meet real estate professional status, because they're going to look at that and say, okay, you don't just need to meet 750 hours. If you're working 2,000 hours in this other job, you need to work in real estate over 2,000 hours. And that is incredibly difficult to do. It's even harder to get the IRS to believe you that you did it. If you meet real estate professional status, any losses that you get from your investments in your passive losses, those can offset any active income, right? So if your real estate, your rentals have $20,000 of passive losses, you can move that to the other side of the equation. If there's no passive income, you move it over and you offset 100,000 of your active income, right? So that's where you want to be, especially if you have losses. So you might be looking at, well, I don't want to have losses from my real estate investments. But on paper, you're oftentimes going to have losses from these investments, especially early on, because even if they cash flow, even if they have income to you, things like depreciation, the mortgage interest deduction, and just maximizing all your real estate tax deductions and everything else you have through the property, those are going to create losses on paper. And whether you meet passive, active, or reps is going to determine if you can use those losses in the year. So let's wrap up here with some quick items and notes about meeting reps and what it takes. So one, your logs are key here, and they are your lifeline to surviving an IRS audit if that should happen. You need detailed logs of the hours you're working in real estate. If you're working in another job and you're trying to prove that you work over half the time in real estate, you also need something that shows the time that you're working in that other job. Those are going to be key to you surviving this audit. I know we talk with a lot of investors, and a lot of investors talk with others. They're like, I don't keep up with my logs. If you want to put yourself in place to take advantage and to leverage this as much as you can, you need to play by the rules and you need to keep those logs. Two, the spousal loophole here is a real thing. So if one spouse meets real estate professional status, they can take their losses and offset the other spouse's income, right? So if one spouse is a high income W-2 earner, the other meets real estate professional status, you can have real estate losses and both incomes can be offset with it. So that's a real thing, and one that helps a lot of people to meet it. Now that spouse needs to be the one that actually meets it. They need to be the one working the hours, keeping their log. It can't be the same high earner W-2 full time that's also doing all the real estate stuff, because that second qualification to real estate professional status, doing it over half the time, is going to take them out of it. Third, you want to be aware of that real estate W-2 job. So that comes up a lot. Hey, I work this other job in my W-2. I don't own the company at all. All that time is not going to qualify for your real estate professional hours, and it's actually going to go have the opposite effect to you, right? That's going to say, okay, you've got to now work even more than the 750 hours potentially to get above that W-2 job. Also, something to keep in mind here is there's a grouping election. You need to be working with a qualified accountant that understands this, because if you have multiple properties, you're going to want to determine whether you should group these together to say, hey, my hours towards all the properties are what I'm going by, or I'm looking at individually. I work 750 on this one, 750 on this one. And that can be your key to passing an audit if this happens or not, if grouping those using all of the income and the hours together. And the last piece here to keep in mind is that once you have a spouse meeting real estate professional status, this is when the roof kind of comes off as far as what you can do tax break wise. This is when you should start to really strongly consider things like cost segregation studies and really focusing on maximizing some of those real estate investment deductions, because you know now whatever losses we get, we can use, and they can get us tax savings this year. Guys, I really hope you found this video useful. Sincerely want to help as many real estate investors understand and leverage tax planning as we can. If you did find it useful and you've already joined our community over at REI Tax University, we are so thankful for you. It's why we do what we do. If you haven't checked it out yet, go over to reitaxu.com. It's a community that we've built out for real estate investors to help them understand and leverage tax planning. So all kinds of resources that we're putting out there, templates, logs, videos. We'll be having monthly webinars and live videos and case studies and things like that. So definitely consider joining that community if you haven't already. We appreciate you guys for being here, and we'll see you next time.